This is the story of a general who pushed his army to the limits of human endurance. The story of a mind so brilliant that it brought Rome to the brink of destruction.
Welcome to this video today, which is all about Forex trading tactics for success. What we're going to be doing is looking at hitting trend changes. So looking where the high probability turning points are, trading them for profit, and looking at the risk reward of doing so. Now, I've kicked off the video with a short clip of a guy called Hannibal. He was an ancient general. He led Carthage against the mighty Roman Empire. And he had a very, very small army, yet he inflicted defeat after defeat on the Romans. And even the Romans admired him. They gave him a funeral with full military honours when he died. And he was the master of the flanking attack. Now, what you have in armies is an army is obviously very strong if you hit it from the front and it's compact. Okay, if you do that, it makes it very hard to beat that army, especially if you've got a smaller force. What you need to do is draw the enemy and then hit them from the flanks, from the side where it's at its weakest. Now, in Forex markets, you can actually mount what I call a flanking attack. Okay, most of the time you should be trading with the trend. Trends are like armies compact. They will steamroller you if you try and fight the trend without good reason. You actually have to look for the moment where you can actually launch what I would call a flanking attack and basically hit the trend when it is at its weakest or most exposed. So when is it at its weakest and most exposed? Well, most trends are fairly gentle in the way they go up or go down, but at some point you get what I call the blow-off coming, and you'll see an acceleration of price, and the ranges of the day will become bigger, and prices will move too quickly to the upside or too quickly to the downside. And if you want to spot and trade these trend changes, I know there's a lot of people out there who say you can do it with price action. I actually think it's easier if you use some indicators. And the first indicator you should use is a volatility indicator. What you're going to find is when a trend accelerates, you're going to see volatility increase dramatically. Use a Bollinger Band and see the price where it is in relation to the outer bands. If it's through the outer band or at the outer band, that is what you want. It's gone too far too quickly. Then what you need to do is get some momentum indicators. Now, it doesn't matter which ones you use, everyone has their favourites. Mine are the ADX, the stochastic, the RSI, or the MACD. But what I like to do is run the chart back a few months, even a few years if necessary, and find out how overbought momentum is, let's say in a bull trend. I don't just want momentum overbought. I want it to be at an extreme, okay? So it's at an extreme on the chart. And then I'll be looking to trade short. Now, when you've got a really accelerated price trend, it's literally moved too far too quickly. What you don't want to do is try and pick the top, okay? If momentum, even if it's at a complete bullish extreme, you don't want to just come in the market. What you want to do is look for some weakness, okay? Now, traditionally, people trade, divergence of momentum. Sometimes you don't need to do that. You can just actually look for just some weakening, i.e. look for a weakening in the stochastic without the turn down. Just so long as that price comes down a bit and you see weakening of momentum, you can get in. What you would then do is put your stop above the high, okay? Now, a lot of traders will put a stop above the high and they'll put it like 10 pips away. Don't do this. Make sure it's about 50 pips or 100 pips away from the top of the bar, okay? Because very often you will see, obviously, one last push to the upside to take out stops. You don't want to be caught by that. Now, if the price does break lower, okay, what you want to do is wait to the close and see how far it's broken. If it's closing in the bottom 20% of the bar of that day, you're safe to stay with that that trade, I think, and basically you should see follow through selling the next day. If it doesn't close, down at the bottom of the bar, okay, it trades or settles in the middle, then possibly you want to get out and try again. And what you want to do when you're doing this is basically be prepared to exit quite quickly if you think the trend is going to turn around again. But let's say you've got a weak close, you get follow through selling the next day, you're probably going to then see stops get hit on the long side. Traders are too bullish. A lot of people who got in late are going to want to get out, and then the trend will move downwards. And when you're trading turning points, you can actually be wrong a good few times. And the reason you can be wrong a good few times is your stop is still going to be relatively close, but your reward is going to be much more. Because once greed peaks and prices start to sell off, they will normally follow through. If you look at any price chart, you'll see this. Big spikes that go, really a long way to the upside, and then suddenly they just collapse. It's psychology at work. Greed has just got the better of investors. Prices have been pushed too far ahead of the fundamentals, and the price breaks. Now, most of the time, of course, you should be trading with the trend, but trading contrary to the trend is actually not only kind of good fun, because you can get a result quickly either way. It can also be extremely lucrative. Paul Tudor Jones once said, people always say you can't make money at turning points, but I've made a fortune. And if you're a disciplined trader and you wait for the right price spikes, those real bullish or bearish extremes, and you hit them, you can make a lot of money and your risk is relatively low. So I hope you enjoyed this video today. Thank you for watching me. Take care and have a good day.